Most trading bots work for a few weeks, then the market changes and the results tank. How do you build bots that adapt, survive, and keep performing long term? In this video, I'm going to show you my top 3 rules for keeping EAs profitable in the long run and how these rules have kept my EAs profitable in the last 5 years of automated trading. What's up guys, Cam here, and I've been running automated portfolios for the last 5 years, and today I'm going to break down the process I follow when I deploy any portfolio to ensure that they're sustainable and geared towards long-term success. Plus, I'll be sharing some of my advanced tactics that you can use to make any EA more sustainable and how to manage times of deep drawdown so that you can turn those stressful times into additional profit rather than losing your account. So let's jump right in. Okay, so one of the first things that I will talk about, and it's about lot size management and really just in general risk management overall. When you look at your MetaTrader profile, you look at the accounts that are running, if you start seeing lot sizes that are psychologically too large and its drawdown is highly volatile and moving up and down, well, what that's going to do to your psychology is put you in a state of fight or flight, and you're going to make decisions that aren't the best for the sustainability overall of that account. And even if you're making profits with large lot sizes, you're going to introduce a level of greed that's not healthy for your portfolio if you're looking for, again, long-term sustainability. One of the things that we'll do here is when I run my optimizations, I am not actually optimizing for lot size. What I'm actually doing is optimizing everything else around that, and then I am modifying the lot size to be in line with my acceptable drawdown so that by the time I put that bot onto the market, the drawdown is modified based on the results of the backtest. So I'll get into the whiteboard here and show you how that might work. So we're in 2025 here. If we move back in time, let's say we're doing a backtest that's 2 years long. So 2023 shows up on the left side of the chart, and this is your backtest, right? This is your backtest that you're running. You're going to see that some of the sets, if this is 100K over the lifetime, as the test occurs, you get into, maybe you make 75K here. Obviously that's not lined up, but that's okay. And then you'll have other back tests that will run that will do something like this and maybe make 100K. And you'll have others that will end up looking something like this and maybe only make 10K. Now let's maybe color code these here. Let's call this test 1, test 2, and test 3 down here. Right now, if I were to look at the results not on a graph and I were to say, hey, test 1 resulted in 100K of profit, but the drawdown was 20%, peak drawdown. As we ran this test here, there were periods of time where if this is the equity curve along with it, maybe it's coming down, but there were times when it drew down 20%. Now on the flip side, this green one here, it actually banked us 75,000. Perhaps the result of that was that it made 75K in profit. Let's say it only drew down 5%, right? 5% drawdown. So that might look something more like this, where you're getting small periods of drawdown and maybe none at all up here, maybe some other ones. But there you go. But the peak drawdown, or let's say the maximal drawdown, is about 5%. So what can we do to make this set here? That's, currently we said this set makes 75K profit. If we were to 4x the lot size as an example, well, then this profit would be 75K times 4x because the lot size is 4 times bigger. So now you've got 300K in profit. And the drawdown would also 4x. So that's going to equal 20%. Now, number 1 and number 2 have the exact same drawdown, but number 2 has 3x the profit. So that's the forward way to look at it. That's the I want to maximize for profitability way to look at it. And that's completely flawed, but the concept remains the same, and you can actually move it the other direction. If you actually had the 100K account that was making 100K in profit over this 2-year back test, and instead of if it was a 20% drawdown, but you said, hey, I don't need to make 100K on this. What I'm actually optimizing for is the drawdown. I want to optimize for how can I make sure that I'm never drawing down more than 5%. So then what you would do is you would take these accounts. So you've got the 100K account. If your profit is here and your drawdown is here, your 100K is drawing down 20% on the back test. The account that profited 75K drew down only 5%. But we say, hey, let's do for simplicity that we want to optimize for just 1% of drawdown. We would basically take 1/20th of the lot size here and 1/5 of the lot size here. So in order to get to these drawdown metrics, we need to make these numbers here. You have to divide the lot size down to get the drawdown to be the right amount. So after doing that, they would look something more like this. The first account would be profiting 100,000 divided by 20. So instead you'd have 5K profit. And the second one, you would divide just by 5. So you would have 15K profit, right? So now all of a sudden, we've got drawdown of 1% and 1%. And all of a sudden, number 2, so if this is number 1 and this is number 2, sorry about the color coding, guys. All of a sudden, if you looked just up here on the top, you would say, yes, this is the best set. It makes the most money. It makes 100K. Great. Then you would just have to make a decision about whether or not this drawdown is acceptable. On the flip side, if you put everything aligned, you have to have one metric that's consistent. That's the control variable across all set files. And it should be drawdown, because that is what's going to drive your psychological analysis of the sets. It's also what's going to drive profitability ultimately, because profitability comes after risk management. You have to manage your risk first to get to profitability. So everything should be optimized for proper risk management. So you optimize all of the back tests and you set them equal to a drawdown percentage. You multiply the lot. The lot could get bigger to get to that drawdown percentage, or it could get smaller. Like if we go back to scenario 3 here, this one here, you might actually be able to multiply the lot size and make it bigger. Like this one might actually have been where the drawdown was so tiny the whole time that maybe the maximal drawdown was 0.1%. Maybe this is already a super conservative set. In this case, we can 10x this one, and maybe this set is the winner because you can do 100K on just 1% drawdown. So I hope this makes sense, guys. So really all you're doing here is level setting every single backtest across one common variable, which is drawdown. And I want my drawdown to never be more than 1% across my entire backtest. And therefore the profit values are going to be modified and the lot sizes of that test are going to be modified to get me to 1% drawdown across every single test in my backtest. And then and only then am I going to analyze the actual profitability of those sets, because now we've got a consistent metric with which to compare those different set files. So at that point, you've now got this common variable here, which is drawdown. So you can look at your entire backtest and see everything consistently. You can see that every single result is based off of the same drawdown percentage, the same risk profile, and now you can compare. But as a follow-up to that, you don't just want to compare profitability. There are multiple different variables that you should compare when looking at your different backtest results. You should be looking at consistency across the trading. And then you've got your walk forward analysis. And if you're not familiar with backtesting and walk forward analysis and out of sample analysis, it's something you should really get familiar with. And you really, in terms of optimizing EAs properly, you absolutely have to do walk forward analysis. There's other videos on that we can share. But if you're looking at your backtest and then your walk forward analysis, let's say you're doing a 1 to 3 walk forward, you should absolutely see some level of consistency across the back test and the forward test as it relates to volume of trades, for example, but also profitability of the back test overall. So let me explain that again in more detail. In a back test, you're going to have the results will have some curve that looks like this, whatever it is, right? But you're going to have a portion of that. That's what's called part of the walk forward. So you've got the forward section, you've got the back section. The back section might be 9 months. Forward section might be 3 months, and that might make up a 12-month back test. When you look at that then, and then you look at the results, and now you've got all of your results aligned to the same drawdown percentage. So they're consistent, comparable results. They're not all over the place. They're all one-to-one comparable. The next value you want to look at when comparing is in the 9-month back test, the volume of trades was 100. And then on the 3-month forward portion, you would expect 1/3 of the trades in the forward portion or somewhere thereabouts. If there were 5 trades, this is a bad test. That's not a good set file. You have hardly any trades in the forward session. You don't nearly have enough to be statistically significant. So those aren't good results. On the flip side, if you have 100 trades in the back test and you've done a 1 to 3, so you've got 9 months, or a 1 to 4, or you could do 1 to 2 as well. And there's reasons to do the different walk forward to back combinations. But in this case, we have 3 months in the back and 9 months in the forward. That's 1/3 of each other. So I would expect there to be 1/3 of the volume. So really what I'm looking for is about 33 trades in that forward test as it relates to that back test. If there's 20, I'm okay. If there's 40, I'm okay. If there's, again, 5, that's no good. So you have to be really careful that you're not getting skewed data, something that's promising you something, but you're actually not, you're not getting the data set required to actually make an informed, good data-driven decision. It's going to blow your account in the future because it's not tested properly. It's outfit. That's another thing to just really keep an eye on and look out for as you're analyzing the data. So the first thing you're going to do is align for a singular drawdown metric. You're then going to compare those and see, okay, profitability is now aligned 1-to-1 because they're all set to the same drawdown amount. And now you're going to say, okay, does the backtest and forward test have equivalent amount of data based on the subset of time that they were optimized for? The next thing you'll look at is overall profitability, because you might look at this and say, yeah, great, I've got 3 times as much history in my backtest. I've got 9 months of my backtest and I've got 3 months of my forward test. And then you'll say, okay, great, this led to 100 trades. This led to about 30 trades. So now you're thinking, okay, all is good. Smiley face. But the next thing, now you need to go to the next thing. So the next thing is we've got to look at how much of that profitability. So in the 9 month, those 100 trades netted us 90,000, 90K in that portion, let's say. In the 3 month section, did it net us 30K? Because that would be ideal, because it's 1/3. This would be perfect. This would show an extremely consistent. If it was 100 trades in the back test, 30 trades in the forward test, 90K in the back test, and 30K in the forward test, you have an extremely consistent, predictable, walk forward, analyzed, adaptive bot that you've now back tested, or EA or set file that you've now back tested, right? This would be extremely, extremely good. Now, of course, you're never going to see anything that's that absolutely, perfect. So you'll see some variance. So you have to understand what your tolerance might be for how different, if it's 90K in the back, but then it's, let's say 20K in the forward, is that okay? Well, to me, that's close enough, but it would be compared to what? I would always ask myself, compared to what? Compared to all the other results in this back test that we ran, are there any other that are better? And how significant are they? What is the profitability trade-off between 1 and 2? What's the balance of volume of trades between 1 and 2? And you can look at all sorts of things. So you want to keep going down the list. You want to look at your recovery factor, your profit factor. You want to look at all of the different metrics that you have at your disposal and make sure that more consistency is possible. And more consistency means a stronger set, and that it's more likely to play out into the live markets and be consistent with what you're seeing on your back test, right? So these are some of the key ways that I'm back testing pretty heavily to build sustainable trading portfolios. Now, of course, with POW, what we do at POW, we have our full tool called Portfolio Builder, and all of the math and sifting and filtering is actually done completely automatic. And we've actually come up with something that we call the POW Score. What the POW Score does is exactly what I just showed on the whiteboard there today. It actually automatically takes every single result from your back test. You might have 100,000 results from an extensive back test, and it will reset the lot sizes of every single one to a consistent lot size, set them all to the same so that they're comparable immediately. It will then sift through them and look for, profitability, recovery factor, profit factor, and all of the different metrics like the ones that we just described. And it will put those into a formula that was created with a combination of our own common sense and experience mixed in with AI to create an algorithm that then produces what we call the POW Score. The POW Score will automatically rank all of your different sets by a score that takes into account all of the logic that we just talked about, so that you're actually, without any work, you're given the best producing set files based on this logic and this process here, not just sorted by profit, but sorted by the POW Score, which calculates all of these things together and creates consistent comparability across all of the different set files that were given to you as a result of your backtest. So that's really how we expedite this and completely automate it. Otherwise, you would be running formulas and Excel sheets like we were doing in the beginning, and it's completely time intensive. So that's just something to note there about a tool that's available inside of POW. If you're interested in applying or joining POW or learning more about those tools, click the link in the description. Okay, so now let's move on to another block of topics. Something that's really kind of been game-changing for me personally that I learned along the way is to actually take your periods of drawdown that you might have with any EA and flip that around and turn it into an opportunity to generate more profit. And it's always the scariest thing in automated trading. This is what's in your learning curve as you're learning how to use bots and trade with bots and you're trying out different things. One of the things that tends to happen early on is your bots will go into drawdown. And this is for all bots will go into drawdown at some point. All manual traders will have periods of drawdown. With automated trading, it's a little bit different because you feel a little out of control. The emotions that come into those situations are the exact opposite of the highs that you feel when a bot is trading and generating you profits consistently. There's nothing like that feeling, especially compared to manual trading where you actually have to be in the game constantly to make profits. When you see a bot that's just trading and making you profits consistently without you doing anything, the highs that you feel from that are extremely high. On the flip side, when your bot takes positions that are losing and it's maybe stacking trades, or it's it just continues to get deeper and deeper into the red, you feel the exact opposite of that high. A lot of early beginner traders and even advanced traders that I talk to, this is where their biggest mistakes happen, or in periods where the bot is going against you in a way, or the markets rather are going against you. So there are some tools at your disposal that you can use to help mitigate that, make you feel like you have a little more control, number one, but really just to start to mitigate some of the risk, but also buy time. What you need to do in those periods of time is buy time. You need to be able to extend the life of the algorithm so that it has time to wait for the market to correct the way that it needs to, so that it can get back in line with what that algo was back tested for. Anytime a bot is in a period of massive drawdown, especially one that was never seen in the back test, you back tested your algo and it had 1% of drawdown in the last 2 years. Now all of a sudden you're looking at your account and it's drawn down 3%. It's an indication that the market conditions that exist currently have not existed in this fashion over the course of the last 2 years. So that happens after news events, as an example. Now, of course, we do have most bots, and of course, all of the EAs provided at POW have equity protectors and risk management tools baked in, and also they will completely pause if you set the setting up. It will pause and not trade at all during news events, but the impacts of that are unknown. It could be up to 4 hours after the news event, could be up to a day after the news event that the market disruption might still occur. But there's other reasons why market disruption occurs. There's announcements, there's sentiment, there's war, there's a myriad of different reasons. If we go back to the drawing board here, let's take a look at, I'll try to draw this out for you, but again, we'll draw another chart here. And if you've got a position, let's say that there's let's say this is gold here, right? So we're trading gold and the market is moving and it's pretty volatile. It's making certain moves like this. And all of a sudden it starts to spike and then trend upward. And at some point you were expecting, the bot was maybe expecting that there was a high here and it took a short position, right? So there was a sell somewhere in here. And then the market decided to gap up and continue this trend upward. And maybe the EA continues taking sells to try to cost average this position, and then your take profit, which originally was here, is now moving up to here. As the markets continue to move up, it's adding more short positions. Take profit is sliding up with it, but the market continues to increase. And now you're in, some massive drawdown as this is occurring. There is a point somewhere on this graph, and I don't know where it is based on the drawing, but let's say that, you can do the math and figure out that, if the market gets here, that's my equity protector. That's where this whole position is going to close out. And if it's in a prop firm challenge, maybe that's at about 4% drawdown so that you don't hit your daily loss target of typically 5%. If you're on a POW instant funding account, that's 10% drawdown. So maybe if you're at 8 or 9%, you've got your equity protector there, or wherever you've decided to put your own equity protection, right? There is some value there. So the way to extend this limit and try to get it up higher into, a zone somewhere up above so that you can buy more time, you can allow the market to extend itself further, would be to introduce some long positions as we move up this chain. So if the markets have decided that they only want to go one way, let's not fight it. Let's introduce a new set file onto that account that's taking long positions. And all along the way, this is closing, opening, closing, opening, closing. So you're banking all the way up. So what that's going to do is it's going to bring your balance up. Your balance hasn't been shifted yet because this is an open position, but your equity is down and you might be drawn down, 2% drawdown by the time you're here. And this is 4%. And that's where your equity protector is. So your drawdown is moving at a certain percentage at a certain rate of time. Because the market increases a certain number of pips, your drawdown is increasing relative to that increase of pips based on the lot sizes that you have open on your short positions. You can introduce buy positions that are a percentage of that overall lot size that you have exposed that will be banking constantly as the markets are going up. So it's going to increase your balance as you go, and it's going to give you, rather than you having 20 pips between this 2% and 4% drawdown, maybe you can get 100 pips out of it, because as your balance is increasing, your drawdown is not increasing as fast as it was when you weren't introducing those buy positions, because the buys are hedging what your drawdown is by banking profit along the way. Now what happens is, invariably, you'll open a set file up that does this, and then all of a sudden markets will correct and go the other way. And this is ideal. This is what you want to happen, because that's going to close out all of these stacks of cells that you have here. Now close, and then you can be relieved, because all of a sudden, all right, we didn't hit our maximal drawdown. We didn't close out the stack of trades at a loss. Markets reversed, and now we're in a position where we've cleared all of those and we're good. Plus, you've now banked here, 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 all the way up. So now you've got bonus dollars in there too that you otherwise wouldn't have had, because you've closed out a bunch of buys on the way up. So as you're increasing drawdown, you were banking cash as you went, and then markets finally reversed, closed out all your sells. Now you're in drawdown on the buys, because now you've taken long positions. Hedging set has taken long positions on the way down as well. So now what you need is the market to then just reverse just a little bit more and close out all of those buys here, and then that's your third stream of cash on this sequence. So you've closed all the sells. That's one. So the sells close. That's one source of cash on this. Your buys were closing all the way up. That's another series of cash. And then the final thing is that the buys are going to close once more when the markets reverse. Buys again. And that's your third. So you've got three areas. These two wouldn't have existed if you didn't implement this hedging strategy. And this one might have closed for a loss if the buys didn't give you more time and space to allow markets to play out and ultimately reverse. Right. So that's an advanced tactic. The logic of those set files, there's some sophisticated things that we can get into, and maybe it's another video where we talk about how do you set the pip step, the lot size, the take profit settings, all of those. There's somewhat of a formula that I've come up with that allows me to understand the width of the pip step, how big the lots should be on the hedged set file. And so we can get into that. It's a pretty deep analysis, but there is some logic behind how you run that, so that it maximizes the extension of the set that's in drawdown, but then also allows you to recover on the way back. So we can get into that in a follow-up video. But that is an advanced tactic that I've used several times in the past when markets are pushing my set files out of the realm of what they've been back tested for. They're in deeper drawdown than I would have expected. Rather than panicking or just letting that run and get to its point of closure at the equity protection point, I hedge it with the set that is instantly opening trades and constantly opening trades so that it's adding profit as the markets go against us, and then close out once things reverse, everything gets closed out, and you actually end up making more profit than you would have if the market would have just turned around initially anyways. So now my final piece on how I keep my EAs profitable long-term and keep them sustainable in the long term is to diversify. And I talk about this endlessly, and I will probably say it in every video that I come out with. You've got to have multiple different portfolios. And the reason why this is important is because I think of everything in terms of sports. I was a hockey player growing up my whole life. I was really, big into playing sports. I played at high levels. In a sports team, you don't just have one player that does all of the work, scores all of the goals, is responsible for all of the wins, right? You've got a lineup of players, and every player has a role on that team. And maybe hockey's not the best example for everybody, but if I draw a baseball diamond, for example, right? I've got somebody on first base, second base, third base, and home. I need my first baseman for when balls are hit this way. I need my shortstop for when balls are hit this way. And I need my outfielders for when balls are hit to the outfield in all different directions. If I just had one person there, we wouldn't be able to cover the whole field. On the flip side, on offense, you need people that are good at hitting singles. You need people that are good at hitting home runs. You need a mix. You need every single person on the team. And it's no different when it comes to automated trading. I need sets that can trade when markets are in ranges. I need sets that can trade when markets are trending like crazy and just simply will not reverse. I need sets that are successful when markets finally do reverse. I need sets that are successful in high volatility, in low volatility. I need sets that could be moved to, focus on indices. I need ones that do well with metals, with Forex, with stocks. Right? I need all of these things. I need sets that can do all of these different things. Some of them can do multiple. Some of them say, hey, with the range and indices. Some of them are, trend and Forex and then sometimes stocks. That's fine. But I need ultimately a lineup that I can say, we give them names. I like to give them names. This is my UJ trend set. This is my gold high volatility set. This is my silver double confluence set. right? On and on. We need as many portfolios as we possibly can have so that we can analyze what markets are doing. We can see, and they should all be running on demo constantly. They should all be running on demo. A lot of times we get asked, why do we have so many demo accounts compared to live accounts? Demo accounts are running 24/7. I don't care if they're in massive drawdown, if we blow accounts, I don't care. I want to see how they play out. I need to see how they play out so I know when I can and cannot use them. It's perfectly acceptable that a EA or a bot that we've created that's highly optimized for trending markets goes into massive drawdown when markets reverse. We shouldn't be deploying that set in a market where reversals are happening constantly. So we expect it to go into drawdown in those markets, or we expect it to not be trading at all. We'll never know how they play out if we don't let them play out. So we've got to have them on constantly in demo, and then we get to pick and choose which of those demo portfolios we push to our live funds at the right time. Common misconception with automated trading is that you don't have to analyze markets at all, that you could just set and forget everything. I spend hardly any time in front of charts, but I can tell you by being involved in the markets which of my set files are going to work well on any given week compared to the others. And I know which ones to deploy. That's because I am paying attention. I'm not just completely out of the game. The amount of time I have to put in automated trading compared to when I used to manual trade, absolutely a fraction of that time. I'm talking 1/100th of the amount of time and energy put in, but there still is energy and time that has to be put in to understand, which of your set files are going to work based on how markets are moving right now and which ones are safer to put on and which ones are riskier to put on. Some of these sets, you might say, hey, I want to put this onto a FTMO challenge right now because it's a little bit more aggressive right now and it's in line with the markets. And I think I can get that 10% that I need to pass the challenge in a shorter period of time. You have to be able to have multiple accounts running constantly to be able to make these types of decisions. If you're not diversified or you're relying on one bot or one provider, you're not going to be able to have the visibility to see. And that's where tools, again, like Portfolio Builder, Set Generator, that I can run a test right now. By tomorrow morning when I wake up, I can have 20 to 30 set files, really solid set files, all diversified, running different strategies, all available to me tomorrow when I wake up. I can get those deployed on demo and watch them run for a week or two and really get a good understanding of the behavior of those set files and when not to use them. So that is a critical step as well. So if you want to start building automated systems that actually last, you need to think bigger than just one single bot. Inside of the POW ecosystem, we actually teach you to build adaptive portfolios and use tools like Portfolio Builder, Banker EA, Red Alert to trade with sustainability and to improve your mindset. So tap the link below to learn more or to join the community, and I'll see you inside. We run weekly live Q&As with me, Michael, and some of the others on the group that teach concepts and tactics just like this. You get closer access to us in the chats where you can send messages to us directly to ask questions about setting up these types of concepts and so much more. So if you got any amount of value out of this video, click the link, apply to join POW, and we'll see you inside there. Outside of that, please subscribe to this channel. Please like the video, put in a comment if you have questions. It's been really great. I love sharing these concepts with you guys. I love watching the community grow, and any value that I can send out to the community of traders, I'm always happy to improve everybody's trading. That's the ultimate goal of this channel here. So thanks for watching, and we will see you on the next one.